Well, good afternoon, everyone, and welcome to B&M Care's funding webinar in association with Solid Accredited Financial Advisors Eldercare Solutions. My name is Angela Hunt, and I am the Sales and Marketing Director for B&M Care Homes. A warm welcome to our existing families joining the webinar today, and also welcome to those of you out there stepping into the world of accessing long-term care for your loved ones and wading through the minefield that is finding ways to fund that care. B&M Care have been operating care homes for 50 years now, and we take the view that providers like us have a real responsibility to share our knowledge with our families as well as the wider community. So today's webinar is part of a series of discovery events that we deliver, which includes the Dementia Awareness webinar and also the virtual dementia tour. You can look at our website again, visit bmcare.co.uk/events for any of the upcoming dates. So let's move on to today's event. Thanks for joining us. I'm going to hand you over now to Nikki Cave from Eldercare Solutions, who is going to take you through today's care home funding webinar. Over to you, Nikki.
Thanks, Angela. Seamless as ever. I'm just going to hopefully be the same in seamless IT transition so that you can see these slides now, hopefully. They visible, brilliant. So yeah, thanks everybody for joining the event. Just from a housekeeping point of view, if you're not familiar with webinars, the camera function and the microphone functions for you are automatically switched off and they can't be turned back on. So if you have any questions, firstly kind of maybe hold them till the end because your questions may get answered as we go through. Otherwise, if you do type in the chat or Q&A box, I can't see that as we go through, but I can certainly have a quick look at the end. Alternatively, I'm going to make sure you have a telephone number and an email address to contact us so you can pick up any bespoke questions at the end. The event is also being recorded, so you don't have to scribble notes. If there's any areas that I go through too quickly, you can watch that back. And probably more importantly, if you've got family members or friends, neighbours in a similar situation and you think this information would be useful to them, we're more than happy for you to share the link. So I know Angela will be distributing the recording to you probably Monday, so you will have that. So hopefully you're on the right event, looking for information around care funding. And I've got the agenda here with a specially selected picture, a visual that I think sums it up very much for anybody who is dealing with this for the very first time. Now, obviously, people watching this will be at different stages in the journey, will have different levels of understanding. But if you are looking at care funding for the very first time, I think all of those words sum it up. And it's certainly where, as a family, we were when we were looking for care for grandparents. So what we're planning to do, the agenda for this afternoon, is to look at the question, a very simple question, but quite a complex answer. Who pays for a stay in a care home? Now, I am focusing just on how it works in a residential or nursing home rather than care at home, but there are quite a lot of parallels anyway. We'll also look at, if you have picked up on any political standpoints and what's been going on there, what has happened to the lifetime cap on care costs that you may have read about. We'll also talk about the family home. Does this have to be sold to pay for a stay in a care home? Is there an alternative? What we know is that this can come as a shock, finding out that care even has to be paid for. And then what people are concerned about is making sure that they can leave money to beneficiaries. They can leave legacies, be that to family or to charities, and to make sure that the pot of money that they do have doesn't run out. And that could come with numerous consequences, which we'll look at as we go through. So that's the planned agenda. Hopefully that ticks a few boxes for what you wanted to find out about. You'll see our website address displayed there throughout the presentation, eldercaregroup.co.uk. You can contact us through that, but I will give you, as I said, a phone number and an email address at the end as well. Now, just before I start working through that agenda, let me just give you a bit of a more formal introduction to ourselves. You may never have heard of Eldercare Group, Eldercare Solutions. So we are a firm of independent financial advisors, IFAs, and as Angela mentioned, we are accredited by the Society of Later Life Advisors. So we don't work for them, they're not a company, it's an accreditation, almost like an examining body, if you like, but they look at your skills, your complaints record, your experience in giving later life advice, and it's really the gold standard to look for. There are only a few hundred IFAs in the UK who have this accreditation. So when people say, you know, go and get some independent financial advice about how to pay for care, statistically, the advisors you're going to be talking to won't have this accreditation and won't have the experience that you'll need them to have to give care funding advice. So we are proud to be SOLA accredited advisors, but even within SOLA, you'll find advisors who have quite a holistic range of services, whereas we here at Eldercare exclusively advise on care funding solutions. That's all we do. So if you ask me about pensions advice or life cover, mortgages, etc., that's not something I'm comfortable talking about. We do care funding advice day in, day out. So we really are very specialist. And I mentioned sort of our family's experience. This is why I set the company up in its current format in 2007, because when my grandparents went into care, we knew nothing. We found out nothing until it was too late. And it was a classic case of you don't know what you don't know. It was nobody's fault that we got no advice. We kind of thought there wasn't any advice that would benefit us. We knew that they would be self-funding. There was a property. We just assumed we had to sell it, use that money to pay for care and hope it would last. And it was only later on in my professional career I found out that there were alternatives, shall we say. So I got on my soapbox and not really got off since. And whilst we are here today at B&M Care's kind invitation and organisation, we have no commercial link with them. We work with care providers up and down the UK. And that's because, as I say, there's hardly anyone that does what we do. And in fact, we're the only firm of IFAs in the UK that only advise on care funding solutions. So that's why you will find us linked in, you know, leaflets and people signposting us from care homes all around the country. We are having money conversations with people, so of course you would expect us to be appropriately regulated, and you will easily find us on the Financial Conduct Authority register, which is where you must check to find anyone that you're taking any kind of financial advice from. Now, we're actually based in Hertfordshire. You may not be, of course, but that's no issue, because even pre-COVID, we would deliver our advice predominantly by telephone, email, more latterly FaceTime and Zoom. And we did that to make sure, well, firstly, we knew that families were busy and trying to get everybody in the same place at the same time is tricky, but also it keeps our cost base down. If we can just have a telephone conversation with somebody to ascertain all the facts and give you the relevant info without having to jump on the M25 for a couple of hours or up the A1, etc., then of course our cost base can be kept to a minimum. It also means things don't get lost in translation. So if I have a conversation with one person in the family and I follow it up in an email, that can just be shared amongst everybody and you're all reading the same information. Because we keep the cost base down, that means any initial consultation that we might have with you, if you were to telephone us or send us an email, that's all can be done free of charge. Okay, it's done at our expense, not yours. And we can even research certain financial solutions for you with no cost or obligation, simply getting paid if you proceed with the product purchase. So that's a bit more about us. Back to that agenda. And I said that very simple question, who pays for a stay in a care home? Well, again, I'm going to try and keep the answer as simple as possible. Of course, everything I say will have a level of detail beneath it. And if we need to go into that on a one-to-one basis, we can do. But keeping it simple, you are either paid for when you move into a care home by the local authority, social services, the council. It's all the same place, but we call it different things as if it's not confusing enough. Alternatively, A completely different funding stream might be our much loved National Health Service. They could sometimes pay for somebody's stay in a care home. Alternatively, you are a self-funder or private fee payer. That's the other commonly used terminology. You can have some overlap between these three, but I am going to try and keep it simple. When it comes to local authority funding, I think if you have any experience of this, you probably know it's linked to how much money you have as to whether you qualify or not. But actually, there's a step that should come before that, whereby your care needs are assessed. So we don't jump straight in and talk about for a care needs assessment. So a social worker to assess somebody's care needs and draw up a care plan. Now, not everybody, when they have that care needs assessment, will qualify and meet their local authority's eligibility criteria. In fact, there's a survey Age UK did a few years back that said something like 1 in 5 people wouldn't meet the criteria. So regardless of whether they felt they needed to move into a care setting or not, the local authority, if they don't agree, then the conversation goes no further. Obviously, then 4 out of 5 do meet the eligibility criteria, and start to move on and have the money conversation. So the care needs are assessed first, the care plan is drawn up, and then the local authority work out who's going to pay for that care plan, who's going to pay for that person's needs to be met. You might know the financial assessment more commonly as a means test, okay? And I'm sure if we were all in a two-way conversation here, you would probably know the answer to my question, well, how much money do you need to have before the local authority will pay? And you'd all be shouting out at me probably 23,000 or £23,250 to be precise. Now that figure has not changed in a decade. So with the rate of inflation as it's been lately, that's going back drastically in real terms. People think it's more generous in Scotland. It's only about £7,000 more generous in Scotland. But in Wales, it's much more generous at £50,000. So if you have less than those amounts and you've met the eligibility criteria as far as care needs are concerned, that's the point at which you become eligible for funding. These figures can be doubled, of course, if we're talking about a couple. So this is just very much the individual amount. There was talk of that 23,250 going up significantly this year it was due to happen, but that's been completely U-turned on. So we are stuck with this level currently. So what counts as capital? What's the local authority taking into account when they do these means tests? Well, pretty much everything. Pretty much everything. There's 3 main exceptions that I want to draw your attention to, and you may well know them already. But you are very much just assessed as an individual. If you have lived your life as a couple and both of you are still with us and only one of you is going into care, it's only the one who's going into care whose assets are looked at. So if you have joint savings and one of you is going into care, probably a good idea to separate those savings out. So the person staying at home takes their 50% out, no more than 50%, because that would be deprivation, but 50% out and into account of their own. Okay. Any money they already have in their own name is not included in this means test. So it can sometimes be a bit of a change of way of thinking to suddenly be assessed as an individual, not a couple anymore. Now, the property is the second main exception. I assume everybody knows this, but apparently they don't. We're often asked about this. The family home, if the spouse, one is going into care, one is staying in the family home can't be touched. It can never be included in the means test. Okay, so it's not that the local authority will come back later and retrospectively claim the money that they've paid. The property is invisible while the spouse or relative over 60 who genuinely lives there continues to live there. Now, if we've got one has gone into care and the other one later goes into care, then of course from that date it forms part of both their means tests. If the spouse who stayed at home predeceases the spouse in the care home, then from the date of death it forms part of the means test. Otherwise, it is invisible. And we've heard of people suddenly, rushing to put the property on the market, to sell it, to release capital, to pay for care. That's not necessary. The capital is protected while it stays inside that occupied family home. Again, there are lots of different scenarios here, sometimes again involving will, trusts, and so on and so forth. That's something we can pick up on an individual basis if you need to know more about your particular circumstance. And the third exception that I will mention, not for everybody, but it's worth mentioning because it affects enough. If somebody has put some of their money into an investment bond over the years that includes life insurance, so this would typically be with a Scottish Widows, Aviva, somebody like that, rather than Barclays Bank. So not these deposit bonds, but an actual investment bond where they say things like the unit value can go up as well as down. And it has the wording life assured on the policy documents. That would typically be a disregarded asset. Now, you can choose to cash it in and use the money to help pay for care, of course, but that shouldn't be the start point, because the start point is that it's disregarded by the local authority. And actually, if any of you are looking 20, 30 years ahead, if you were to come into a lump sum and take advice from an IFA, they may very well suggest you put it in one of these bonds because it could outperform what you would get in a bank account. And it would just so happen to be a helpful side note that it would then be exempt from your future means test should you ever need care. So those are the notable exceptions, but everything else, cash under the bed, ISAs, premium bonds, national savings, stocks and shares, rental properties, holiday lets, business assets, all of that would be included just for the individual going into care in their means test. So it's hardly a generous system, it is a safety net system, okay? And that we've talked about there is capital, the entry point to getting state funding. But I think people overlook the fact that your income is a factor as well. Okay, so when the local authority do these assessments, they are taking into account also how much income you have, and you are expected to contribute the majority of that income towards what the local authority agree to pay for you. So I say this because we've, again, spoken to families over the years who think, well, if my loved one were to run out of money, it's okay, the local authority will pay. We don't think they'll pay as much as the care home is charging. So perhaps my loved one could just add their state pension on top, and that would pretty much bridge the gap. And what we're saying is that's not how it works. The local authority will deduct, in effect, the pension from what they will pay. So whatever they say they'll pay, it's a combined contribution. So if they say they'll pay 700 and you've got a 200 a week top up, they're actually only paying 500. Okay, so that's massively overlooked. If we are talking again about a couple scenario and one of the person going into care has a private pension, they can leave 50% of that private pension carrying on being paid to the spouse at home, but their state pension, all of that, and the other half does have to go towards what the council will pay. Local authorities, as you would expect, and ever more so at the moment, will have a limit on what they'll pay, but this is really important. If you are being state funded from the very beginning, okay, you qualify for the local authority to pay for you from outset, then they must always find a care home place that meets your needs. And part of meeting your needs might very well be that it's got to be in the location where your loved ones live so that they can visit and all those sorts of things. But they have to offer a care home place that will meet the person's needs and that they will pay for in full, accepting that the income has to be put towards it, of course. But what I mean by that is there has to be a no top-up option. So rather than the local authority just saying, here's a list of care homes that we've got contracts with, and you ring them all up and they all want a top-up, in this scenario, you'd have to go back to the local authority and say, we need a no top-up on is to find and fund a care home place that nobody else has to pay for. All of these ones are asking for top-ups. Where's the no top-up option? Okay, because not every individual has a family member that could pay a top up. So there has to be this. That said, once you top up option looks like, if as a family or the individual, you don't want to accept that place, you'd rather the person go somewhere else, perhaps nearer with better facilities, etc., you can ask the local authority to transfer that monetary payment to a different home. They won't pay more, but the amount that they've agreed to pay can be paid to a different care home. It's just that that care home might be more expensive and might want to top up. Well, then that's legitimate. They can request a third-party top up and you can choose to pay it. But there has to be that no top up option first. The other time, perhaps more relevant to the audience, is the other time that a third-party top up might be required is if somebody actually starts off as a self-funder, they don't get state support at the beginning, they pay for their own care, but their assets run out at a future date. If at that point the local authority steps in to take over the funding, it may very well be that there's a gap between what the local authority will pay and what the care home will accept. And if those two parties can't negotiate between themselves and agree on something, if the care home still needs a bit more in order for the person to stay there, then that's when a third party top up can otherwise be requested. Okay, so it's, by the way, not a local authority who moves somebody from a care home. It's whether the care home will accept local authority funding or not, and if they require a top up or not. And it would be the care home that, in effect, would be asking for the move to happen, not the local authority. So that's a whistle stop of the state funding system, our safety net system. As I say, it's not generous particularly, but it is there to make sure that, you know, nobody is thrown out on the street, as it were. Now, that's been a system that's been around for a very, very long time. And if you followed the sort of politics of social care, you may or may not have picked up on a lifetime cap being introduced on care costs. And the legislation for this was first laid down in 2014. I've been advising long enough to have seen that come in, see what all the changes were going to be, spend ages unravelling those changes, only to watch them U-turned in 2015 and abandoned. And then I've had the privilege of seeing them introduced all over again by Boris Johnson on the steps at number 10. We shall make sure that, you know, catastrophic care costs are a thing of the past. Saw all the revised legislation coming in, got the grips with it all. It was set at a new figure rather than 72,000, which was the cap introduced back in 2014. It was going to be 86,000. I had a couple of slides as part of this presentation that went through it all, explained it all, and actually pointed out that in the main, it wasn't going to affect people in the way they thought it was, because it was only ever going to be the local authority contribution that clocked up and counted towards somebody's cap, not what they were actually paying. It's all a bit of a nonsense. But rather than spend the time explaining how it would have, should have worked, I don't have to do that because the whole thing has been cancelled again. So we know there's yet another commission ongoing to review social care, but I honestly think it's focusing much more on the system and the joining up of the NHS and social care rather than purely being around how can we change the funding. In any event, nothing's going to happen quickly. So I think for the purposes of where you all are perhaps watching this today, you just assume there will be no changes and carry on making provision for yourselves. The second funding stream that is completely separate to the one I've just outlined, often gets muddled. The NHS, our National Health Service, can sometimes pay for somebody's stay in a care home. Now, this is not means tested. It has absolutely nothing to do with your money. It's all about your healthcare needs. So the best way I can really explain it, and it's almost a webinar education piece in itself, and I wouldn't be presenting it because I'm not an expert on this, but in layperson's terms, when you go to hospital, you don't get presented with an invoice when you leave, okay? And you're not usually in hospital just because you have social care needs. You're not there because you need somebody to help you with food preparation or washing or dressing or getting in and out of bed. You're in hospital because you've got a healthcare need. So that's why the NHS is paying. It's the same if you were in a nursing care home where you're there because you've got health needs rather than social care needs, or you may have both, but you've certainly got healthcare needs, then the NHS may pay for you under something called NHS Continuing Healthcare. They use the words like intense, complex, unpredictable when describing your care needs. So it's not easy to get, and it's certainly not relevant while you're in a residential home with no nursing needs, but it is there potentially for the future. So be aware of it. There's a level beneath this continuing healthcare being that they pay for everything. If you just need a little bit of nursing care support, then they'll pay £235 a week currently directly to the care home. And this often covers the difference between a sort of residential care home fee and a nursing care home fee. So be aware of these. And if you need more information, there's a really, really good Age UK fact sheet all about this. So state funding means tested, NHS funding about your health care needs rather than your social care needs. And if you have too much money to get the means tested support and you're not poorly enough to get the NHS support, that's what puts you into the self-funding category. And pretty much all of your care costs have to be met yourselves. Now, it's literally the only positive bit of information here for self-funders, and that is, if you haven't heard of it, there is a state benefit, not means tested, tax-free, does not need to be therefore mentioned on a tax return, for example, called attendance allowance, claimed from the Department of Work and Pensions, paid in the same way as the state pension is. And this is a benefit for self-funders. So people at home might be getting it because they needed a bit of help with gardening, Meals on Wheels, that sort of thing. That's what my mother-in-law got it for. And people assume, if they've even heard of it, that when you move into a care home that it stops. And that's not true. If you move into hospital, it stops after 4 weeks in hospital. But if you're in a care home and you are paying for it yourself, you can claim or continue to receive this state benefit. And at the higher rate, it's nearly £6,000 a year with no tax to be deducted. So it may not make a huge dent in care home fee bills, but it's certainly worth knowing about and claiming if someone's entitled to it. The difference between the two rates, the lower rate is simply if you just need somebody to help you during the daytime. The higher rate is if you need somebody to attend to you during the night time. Either, I think it's sort of broken down to sort of 3 interventions, somebody popping in 3 times a night, or popping in for a total of about 20 minutes worth of attendance. That's normally the crossover. It used to be the case that simply by virtue of being in a care home and needing 24-hour care, you'd get it, but they are being a little bit more diligent now. Call it cost cutting, the cynic in me, but they're making it a bit tougher to get this. But do try. You can ring the attendance allowance helpline on government's website, and that registers your claim, the date that you've asked for the form. They then send you a form, which is very long, but they give you, I think, about 6 weeks to complete it. And then, assuming you meet all the criteria and you've needed care for at least 6 months, they can backdate it to the date you first phoned them. Okay, just a little tip there. Otherwise, as a self-funder, if we sort of look at what could be available state support-wise, there is some other help, but only if you own a property and have capital less than the 23,250. Actually, that's quite a lot of people. There's an awful lot of people who are asset rich with a property but don't necessarily have a great deal of liquid capital. So I'll tell you about it in case it applies to your scenario. It's another one of these things that the local authorities introduced that makes life far more complicated than it needs to. But if you own a property, you're moving into care on a permanent basis, and that property is not occupied by a spouse or a relative over 60, in other words, it is going to form part of your means test, then the local authority have to ignore it for the first 12 weeks of you moving into care. So in other words, they ignore it for 12 weeks, your other savings are under 23,000, they have to fund you as if you were local authority funded. So all of those rules and the explanation I gave you at the beginning about how that works, that would apply for these 12 weeks. So you still have to contribute your income towards what they'll pay. They'll limit what they'll pay. So they may only pay 700 or so, but whatever it works out as being, perhaps a 300 or 400 a week contribution for 12 weeks, it doesn't have to be paid back. So it's free money. And it can be paid to the care home of your choice, not the care home on the local authority's list, because you are a self-funder. If you're getting the 12-week disregard, you're a self-funder because you've got a property. So of course you're a self-funder. You don't move into one home for 12 weeks and move into a different one. But as I say, the local authority can restrict what they'll pay. So the home that you've chosen may very well want to top up. And I said earlier that those sorts of top-ups have to be paid by a third party, just to make it complicated and blow your mind. But remember, this is being recorded, so you can watch it all back. Under the 12-week disregard, you can be your own top-up because you're a self-funder. It's a slightly different rule. So if you've got £20,000 in the bank, the local authority agrees to pay £700 or £800 for 12 weeks. You hand over your pension to them, and you can pay any top up to the care home from your 20,000. So it just gives that money it lasts a little bit longer. It gives people a bit more time to think what to do with the property and not feel completely and utterly rushed. Now, if you or your attorneys do decide to sell the property, it doesn't have to be sold within the 12 weeks, because there's another option that you can take advantage of from the local authority. And, we said at the beginning, do you have to sell the property? Use this time to think about, do you want to sell it? You don't have to. You could rent it out. Now, that's a conversation in itself. Renting a property out, lots to think about. Got to pay tax on the rental income, wear and tear, void periods, capital gains tax on the property after 3 years starts to build up. Lots of things to think about. But it does work in some situations. If there's a good opportunity to get rent, perhaps it's in an area with good schools and you'd get a high ratio of rent to property value, absolutely think about it. Now, if you're saying, in your own mind, yeah, it sounds like it could be a good idea, but even the rent plus the pension plus the attendance allowance doesn't quite cover the care fees, we've still got a gap, we've got to sell. I'm going to just say to you, no, you still don't have to sell, because you could take advantage of a scheme that the local authority will offer. You can't take out equity release in this scenario because it's an empty house, and you won't get equity release on an empty house unless it's equity release by another name offered by the local authority. So they will offer citizens a deferred payment agreement or a deferred loan. All councils have to have a deferred loan scheme in place, but they can turn you down individually. So if the property, for example, has any structural issues, if there's already a loan or a mortgage against the property, or it's low value, they'll say no. But they can't just say no without it being one of those reasons, because they're given a big pot of money from central government and it's kind of revolving. Just as they lend out to one person, somebody else is paying it back. So the money should be there, and it's available for exactly this purpose, to either allow somebody to rent the property out, or simply to give you more time to sell the property, but knowing that 12 weeks is hardly likely to be enough time. So be aware of it. It does have interest attached to it and setting up fees, but much lower than a typical equity release mortgage. You do still have to meet the care eligibility criteria. So if they don't think you need to go into care, they won't make this loan available to you. And it's only available once the assets are under the threshold. So you might start off doing it all yourself, and then the savings that you had run out or get down to 23,000, then at that point you could apply for the loan. The good news here is the local authority won't restrict it to the 700 or 800 a week. They'll lend you what you need. That's available through the scheme. So it really is a very helpful option if you're not already aware of it. The property would still have to be sold at a later date, but not during the lifetime of the person in care. And if you could find other assets within the family to pay the loan off, then the house doesn't have to be sold. So it can work for some families. And as I say, it follows on from that 12-week free money. Do not allow the local authority to start ticking up a debt from day one. You should get the 12 weeks of free money, and then it starts to accrue as a loan. Okay, but if you need more information about that, we can't talk on behalf of the local authority, it's their scheme, but we can certainly talk to you generically about it and weigh up the pros and cons. So if we then sort of look at the self-funder as a broader category, that might be people who've decided to sell the property, maybe have already sold the property, maybe have investments, maybe have 2 properties, maybe just have significant savings. When we talk to families, and it's usually the sons, daughters acting as power of attorney, and they're often getting in touch with us at the time that they're choosing a care home. When they're doing that, they share with us 2 main concerns. They say, well, we know we should be checking out what we can afford, and we're looking at these care homes, but we're finding it difficult to work out what we can afford because we don't have a crystal ball. So we know that the care home is this much per week, and they're multiplying that often by 52 and dividing that into their savings, and they're forgetting that they should be deducting somebody's pension and attendance allowance from that fee, because that income isn't really going to be needed for anything else. It can go towards the care fees, which are typically an all-inclusive price. So suddenly that makes the savings go a lot further. But even doing that bit of cash flow forecasting, it's still tricky if we don't have the crystal ball and we don't know how long somebody will be in care for. Then that naturally leads into the other concern of, well, what does happen if the money runs out and piggy bank goes empty? These are 2 genuine, valid concerns, I understand completely, and we are not able to address these concerns in every case. But for a huge number of people who are going to have to self-fund care, who do have assets that mean they'll not see local authority funding for 3, 4, 5, 6 years, for those people, there is a solution that about 85% of them haven't heard of and may never get to hear about. Now, the great news is you're on this event, you now will get to hear about it. What you do with that information is up to you. But fancy never knowing about it and it actually turning out to be something that would have worked really well. Well, that's me. That's exactly how it was for my family. We found out about this solution when it was far too late to use it, and it would have been perfect for funding my granddad's care. So, as I say, it's not for everybody, but we do suggest that you at least get the facts and figures, which is what our job is to do for you and with you, but get the information and make an informed decision rather than remaining in the 15% and not knowing that this was an option for you. So what am I talking about? It's a way of putting a cap on care costs yourself. The government's not going to do this in the foreseeable. So you have 2 options. You pay for care, pay as you go, using the assets, taking what you need every month, every year, and kind of hoping it doesn't run out. So that's one way of paying for care. Or you consider this, which is a type of insurance. You can insure care home fees. Now, obviously, when I use the word insurance, people typically think of that as something that you have to do in advance before you need it. You know, you have to insure the car before there's a car accident. You have to insure the house before there's a flood. With care home fees, you actually can't insure them ahead of time. You used to be able to. You could pre-fund long-term care in the old days, and those policies are still honoured, but you can't purchase them anymore. You can only purchase insurance for care home fees at the point of going into care or once you've moved into care. So you have to have a bill, you have to actually be being invoiced for care in order to qualify for one of these. Now, the technical term, the Google search engine term, if you like, if you want to go off and look up more about it, is a care fees annuity. Doesn't really trip off the tongue. People don't know that word necessarily, and if they do, and even people in my profession, they get it a little muddled with a retirement annuity, pension annuity, and they say things like, oh, you don't want one of those, they're really expensive. You don't want one of those, they're poor. Some pension annuities, I'd say, yeah, they're not brilliant value. Why? because the person buying a pension annuity is probably in their 60s, probably in reasonable health, may well want their annuity to be linked to inflation, may well want a widow's pension attached. That's a lot to ask an insurance company to provide from a lump sum of money, because the insurance company's thinking, well, yeah, we could be paying this out for 30 years. So you may well have a £500,000 pension fund. We're only going to give you £20,000 a year because we could have to pay it for 30 years with indexation. So that's where they get their sort of bad name. But if you take the principle of a pension annuity, which is to pay a one-off lump sum upfront, give it to an insurance company, and in return get a tax-free income for life, might that work quite well as a way of paying care fees, where we need a particular income for the rest of our life, but we don't know how long that will be. And to have the option of just paying once a lump sum up front and knowing that everything else is protected, might that work? And of course, a care fee annuity is not going to be expected to pay out for the next 30 years. Our average client age is 89. And obviously, these people buying care fees annuities have got some health conditions. So where these policies are different is that they are individually underwritten. So everybody's quote is different based on their age and what their medical records say, what the care home has to say about them, what medication they're on, and what help they need day to day. So the insurance companies who offer these policies, so that's not us, we are a broker, an intermediary. We get all the information from the family, take it to the insurance companies, and they go off and make these inquiries, write to the GP, ring up the care home, have a chat about the person. They don't involve the individual at all. This all goes on behind the scenes, but they will use that information and their own experience of quotes that they've produced over the last 20 years or so to come up with a bespoke price for what that individual needs. So our job will be to talk to the family and say, look, how much are the care home fees? How much income does your loved one have? So what's the gap? And we go to the insurance companies and ask for a quote to fill that gap. So we're never asking them to pay full fees, because that's simply going to make the annuity policy more expensive than it needs to be. We suggest using a person's income to part pay the fees and using a care fees annuity to pay the balance of fees. Okay, and each insurance company will take a different view and offer a different price. So it's really important to get the quotes from everyone that offers these policies. And that's what we do. We're whole of market. We go and do that for you. You can't, unfortunately, go direct to the insurers yourself. It's such a specialist area. Because, of course, what if you didn't need one and you accidentally bought one because you didn't realise that the NHS should be paying for your loved one, for example? So they won't deal with you direct. You come through at a qualified specialist. And part of the benefit of using somebody like ourselves is not only will we go and get the quotes, we'll then explain to you everything you need to know about those quotes. What about fees going up? What about if the person were to die early? What about the impact on the estate? What are the features? So our job is to get the quotes and then write an advice report for you. Compare it to the other options. And actually, in my view, there is only one other option, which is to pay as you go. And if you pay as you go, that does carry risk in the event of somebody living a long time. Buying an insurance runs the risk if the person doesn't live a long time, because you may well lose money on it. Once you've bought it, there's no refund unless you've included extra capital protection. So our report goes through all the things that you'd now start to be asking, like, if I buy one and my loved one moves care homes, does the money go with her? Is it portable? Yes, it is. What does happen about fee increases? Well, we'll spell out your options for that. And I used the word risk and losing money, and I do use the word gamble. These policies are a gamble around somebody's life expectancy, and there is no risk option. These are insurance policies, so there's always going to be some risk, but you can pay to have extra capital protection added, or you can buy these policies with a delayed start date, which achieves the same thing actually. And lots of IFAs, even those specialist ones, don't ever seem to put this forward as a genuine option, and it works really well. Because what you're doing is saying to the insurer, I'm going to buy a policy from you today, but I don't want you to start paying out for a year or 2 years. I know my mum's in a care home, but we're happy to carry on paying the fees in full for a year or two, and then we'd like you to pick up the bill from year 3 onwards. So that gives the longevity protection. The price of the annuity comes tumbling down if you ask the insurer not to pay out for 2 years, of course, because they're thinking, well, that's 2 years of money we're not paying out, we'll knock that off the price. So you're buying a much cheaper policy. And if you're buying a much cheaper policy, you're going to lose less if the person dies early. So this is an option that really has merit, is the best of both worlds, and we'll explain it properly when we do our reports for you, part of the advice process. We'll also make sure you're reminded that these policies are fully protected by the Financial Services Compensation Scheme. So all of the income is protected, no cut-off point. So they're really very safe, safer than your savings, which are capped at £85,000 worth of protection. So let me just give you a very quick case study to sort of wind things up and bring it together, and maybe explain this abstract product to you in a bit more clarity. Mrs. Evans, that's not really her, that's not even really her name, but it is a genuine case. And of course, please forget these figures as soon as you've seen them, because everybody's case is different. There's no point saying, oh, but you said in that presentation that it would cost X, Y, Z. Yeah, for Mrs. Evans, in her scenario, not necessarily how it's going to pan out for yourselves. This lady was 88, she'd had a stroke and therefore couldn't live independently in her own home any longer. She had already actually built a bit of a relationship with a care home by attending some of their community events, planning ahead and knowing that that was the home she wanted to go to if she ever needed to. Now we've actually come to the moment that she's got to make the move. She's a bit worried that she can't actually afford it. And what she wants to do as well, and it was really her feelings being shared with us by her daughter, her attorney, was that she definitely wanted to leave something for the grandchildren and the charities that she'd always supported. That's not unusual. So we took down some information. This is a broad scenario, a summary of her financial position. It was a care home a bit further north from us that was costing £1,200 a week. And she had around about £15,000 a year. She was claiming attendance allowance. She had about £15,000 a year to put towards those fees. So our sort of problem solving was, how does she best find £47,500 a year to meet her fees? Now, she had cash at bank of £50,000, so she's over the 23,000 threshold. But in any event, she's also got a property, and they have already decided to sell. They didn't want the hassle of being landlords. They wanted to get everything into liquid cash so that they had options about what to do with the money. So we've got a pot of 300,000 from which to find 47,400. She hasn't really got much in the way of personal expenses. The family said that they were happy to sort of buy toiletries and clothing here and there when needed. So the default option, and this is what I was saying to you, 85% of people that would be in this situation without knowing that there's an alternative would do this. Where they put the money once the house is sold will vary. Some might put it in national savings, premium bonds, some might invest it, but really anything stock market related, that can go down as well as up, and that's not just something you say, it's something that does actually happen. And most attorneys won't want to take that type of risk with their loved ones' funds. Would the money run out in Mrs. Evans' case? Well, yeah, actually, if she lived in care for 6 years, that's the point at which the money would run out, assuming that fees went up by 5%, income went up by 3%, and that, as I say, either the family cover her personal expenses or the interest on that money covers it. No one knows, as we said before, without a crystal ball, if this will play out or if it won't. But my point is, it does come with a risk. What happens if the money runs out? Is she in a care home where the local authority will come to some funding agreement? Would she have to move? Would the family have to pay a top up? These are the sort of unknowns. But that is the default for 85% of self-funding families. Now, what we did, because the care home Mrs. Evans was looking at worked with us, signposted them for a conversation with us, and we put out the idea of the care fees annuity, explained what we thought it might look like, how it might work, what it might cost. And the attorney said, yeah, find out for us, please, get some underwritten quotes. We understand there's no cost or obligation, so why not? Get us the quotes, give us the advice, please. So we did, we wrote our advice report, and the result was that the family spent, please forget this figure because it won't be applicable for you, but in her scenario, they spent £165,000 out of her £300,000 pot to pay then to secure this £47,400 tax-free income for the rest of her life, whether that's 1 year or 10 years. So they're, if you like, gambling around about half the money to protect the other half. Mrs. Evans needed to be in the care home for around 3 years, thereabouts, to sort of break even. If she died before that, the estate's lost money, but the peace of mind has been secured. If she lives longer than that, the other 45% doesn't need to be touched. Okay, the insurance company is taking the financial hit from that point forward. So, as I say, not for everybody, but the family in this instance decided it was for them. It looks very different graphically. You see a big dent in the estate to start with, but then you see a flat line and no chance that that money is going to run out, provided she stays in that care home and that we've made provision for the fees that increasing. Obviously, if she moves to a more expensive care home at a future date, then we'll have to look at the situation again, but she's still going to be in a much better position than if she had no annuity. The NHS may cover part of that funding gap, and indeed the new care home may just simply agree a slightly lower fee because they'll find this policy attractive to them. Someone moving in able to guarantee, most of the fees for life is much better than entering into a contract probably with the local authority. So that's a different approach. It's now simply saying you've got two options rather than perhaps the one option that you thought you had. So this family did it because it ring-fenced that remaining 45%. They never had to worry about asking the local authority for funding and potentially that being turned down or not being appropriate for the care home that she's in, having to move, etc. And they didn't have to worry that if Mrs. Evans later on qualified for NHS funding, that she'd suddenly lose this annuity. She wouldn't. If she didn't need it, it's still her income and she'll still have it paid, but paid directly to her. When it's paid to the care home, it's tax-free. When it's paid to the individual, it's taxed. But it's taxed in part. They don't take 20% off the whole amount. They work out how much is return of capital, how much is interest, and they only tax the interest. So it's definitely income for life. And as I've said a couple of times, we do not charge for getting the quotes and producing our report because we know that most people want to find out how this would all work before they're willing to part with any money. We understand that. There's no fun in settling an invoice for something that you don't want to buy. We know that setting out fees for research and fees for the report are barriers. You don't know whether you're going to want one of these until you've got all of the facts, all of the figures, and had all your questions answered. So we simply charge a fee at that point if a purchase is made. So it does mean we do work for families and don't get paid, but it's a cross-subsidy model because getting the fee, and it is perhaps a slightly higher fee than we would charge if we were otherwise charging for research and reports. That is cross-subsidising, but it's a model that we and clients to date are very comfortable with. It's very transparent, but if you'd sooner pay somebody fee for doing the research and then another fee for doing the report and then another fee, perhaps a lower fee, admittedly, for purchase, I'm sure those models are out there as well. So just in closing, these are the 4 insurers that offer care fees annuities, but as I said, you can't go directly to them. You need to instruct a broker such as ourselves to go to those 4 companies for you. And it's really important that it's a broker that understands the market, doesn't go toddling off to get pension annuity quotes, because that's the wrong product. And it happens. We've had people come to us telling us of some strange insurance companies that are offering these products. But if it's not one of these 4 and it's not called a care fees annuity, it's not going to be the right price for you. It's not going to be good value. So what we suggest really is that you should do your due diligence and your shopping around when you choose an advisor, because once you've chosen an advisor, they'll do the shopping around for you. Does that make sense? And actually, if you choose 2 advisors, it gets really messy because we're going to the same 4 insurance companies. Only one of us can have access to updates. So one of us is working completely in the dark. And it's pointless because you get the same quotes from the same 4 companies, regardless of who you chose. So do your due diligence and choose an advisor first, and then just instruct one of them. Make sure they're SOLA accredited. As I said to you, we are. Make sure that you can easily find them by just typing in either the advisor's name or the company name on the FCA register. That's really important as well, to make sure they are who they say they are. And what we recommend is that you then look at independent testimonials. We collect our client reviews on Trustpilot, and make sure that the reviews you're looking at pertinent to care funding advice, to buying a care fees annuity, if that's what you want us to look at for you, not mortgage advice or protection advice or generic investment advice. If you want advice about a care fee annuity, look up reviews that talk about the advice for a care fees annuity. And as I say, ours are easy to find on Trustpilot. So get comfortable that you're talking to a specialist. Don't, in my opinion, make it all about the fee and the advice fee, because relative to care home fees, it's a drop in the ocean. You get what you pay for. If you're paying a bit more, that's because they're a specialist who've put hours and years of time and effort into understanding this market. You know, we really add value because of our experience. We can get discounts from the insurance companies. We can sometimes get fee cappings from the care homes. All these sorts of things would more than offset the advice charge that's levied. So maybe look beyond that, look for the experience and specialism, and also the speed at which you're likely to get quotes. We have a dedicated individual whose sole day job is to chase these quotes through and make sure they're happening as fast as they can. So that's really our event coming to a close. Well done for sticking with it. I've landed on this particular page of our website because I said I'd give you a phone number and an email address, and remember, you're getting this recording, so you will have this to hand. Our free phone number is office hours 9 till 5. Leave a message if we're not there. You don't need to speak to me. My team, Tracy, Sarah, Roger, Mike, all as qualified as I am, so you can ask questions of any of us. You can equally pop your questions in an email if that's easier, to advice@eldercaregroup.co.uk. And this particular page of our website, there's generic information everywhere, but this particular page, the care fee annuity page, has a calculator on it, a ready reckoner. Now, it is just an estimate. We can't stress that enough. You plug in the age of the person, how much income they have, what the care fees are, and it will tell you what we think the care annuity will cost based on quotes that we've obtained for the people of the same age, and it'll do it based on that data. But of course, when we do the underwriting, it could change by quite a lot when they look at the individual's conditions. But it's a good ballpark. You can do that and contact us subsequently. You can do that and ask us to contact you. But we've had a couple of people say that they've filled this form in and then they haven't heard from us. So if that is the case, please just give us a ring, because it must mean there's something wrong with the calculator. But you don't have to do that. You don't have to press the contact us. You can just get the number yourself from using that. Hopefully that's all been useful to you. You may well still be confused, but hopefully a little bit less confused. We've looked at how the state funding system works, our means tested system. We've looked at our possibility of NHS funding, what options you have if you're a self-funder, the fact that you can claim a state benefit called attendance allowance, that you might get some help under a 12-week property disregard, or maybe benefit from a local authority loan. And then in closing, we've looked at a product called a care fees annuity that we can give you full and clear advice around as a possible alternative to just running the money down and keeping your fingers crossed that it will last. So hopefully that's been helpful to you. Please do share the recording around with anyone else that you think would benefit from it once you receive that from Angela. And otherwise, have a wonderful weekend, and let's hope it gets a bit warmer soon.